So this is great. So she wants to talk to you about credit, and I'll just turn it over to her. And I want to thank you for spending your afternoon with us. Welcome.
Awesome. Hey, y'all. Thanks so much for having me today. I'm going to go ahead and share my screen really quick so you can see what's going on. Can everybody see that? Nod at me if you can. Perfect. Okay. All right. So as he mentioned with that wonderful introduction, my name is Sarah Lorenzen, and I am an outreach specialist for Oklahoma Money Matters and Ready, Set, Repay, which let me back up. My computer is not cooperating. Hold on. There we go. Okay. So basically, I work for Oklahoma Money Matters. Oklahoma Money Matters is an outreach initiative out of the Oklahoma College Assistance Program, which really comes from the Oklahoma State Regents for Higher Education. If you're not quite sure what that is, the best way I can describe it is we're kind of like the Department of Education, but for public colleges and universities in Oklahoma. So we have this initiative, and when we're not in the middle of a pandemic, I am traveling all over the state on any given day, talking to students about credit and budgeting and student loans and anything that involves money, basically. So today we're going to talk a little bit about credit, and as soon as my screen, for some reason, my whole PowerPoint just crashed, so give me just a second to get that to pull back up. Okay, looks like it's shared again. Can y'all see that? Okay, sorry about that. I don't know what happened. It's never done that to me before. All right, so now I've kind of given you a little bit about me. I've been doing this for about 2 years now, and I was kind of letting the staff know this is sort of a passion project of mine. I made some really dumb decisions when I was in college with my credit, and so I really enjoy being able to come and talk to you guys now. So you have a little bit more information going into college than I did back in the day when I was in college. So you can make maybe some smarter decisions. So what we're going to kind of talk about today, just so you sort of know, is we're talking about the difference between credit scores, and credit reports. A lot of people use those three interchangeably, and they're very different things. So we want to kind of talk about what the difference is. I want to talk about why it matters, what your credit looks like, and why it should be important to you that you keep good credit, you maintain it once you've built it. We're going to talk about what makes up a credit score, the different pieces of it, and kind of what factors into that. I'm going to talk about FICO scores and Vantage scores, which are the two most common that you're going to see when you get a credit report. And then we're going to talk about how you build and keep a good credit score once you've got it. So first things first, what is the difference? So credit is actually money that is extended to you by a lender, whether that be a credit card company, a student loan, you know, an auto loan, a mortgage, that is given to you based on the good faith that you are going to make payments to pay that back with interest to a lender. If they deem you worthy of giving credit, you will be given that money. So that is what credit actually is. A credit score is what most people think of when you hear the word credit. They're like, oh, well, my credit is bad. Well, your credit score may not be the best. And so your credit score is going to be a number between 300 and 850. And basically what it is a bunch of factors, which we'll talk about here in a minute, that all come up with that number. Everyone over the age of 18 has somewhere around that line. And depending on where you are on that scale depends on interest rates that you get and other things like that. But it basically tells a bank that if they're looking to extend you credit, how worthy are you? Do you pay your bills on time? Do you spend your credit cards up to the balance? Do you, do have unsavory credit habits, we'll say. And then a credit report is going to be a detailed breakdown of all of your credit history. So it's literally going to say every account that you have, whether it's a credit card, a car loan, a student loan, is going to be on your credit report. And it's going to have a breakdown of every time you've made a payment, every time you've missed a payment, every time you have, closed an account or opened an account or applied for credit. That's all going to be on your credit report. All right, so let's talk about why that matters. Let me back up. Those credit reports, there are 3 of them that you are going to find: Equifax, Experian, and TransUnion. And those are the 3 bureaus that keep those records for you. So if you hear me talk about the credit bureaus, that's who I'm referring to, are those 3 companies. So why does having good credit matter? Let's look at a couple examples. So I will preface this with, in these examples, someone who has good credit might actually have an interest rate much less than this, and someone who has bad credit might actually have an interest rate much higher than this. But these numbers are pretty easy to calculate, which is why I like to use them, because they're pretty easy to kind of see my point here. So if you have good credit and you go to purchase a car for $20,000, you get a 6% interest rate when you go and you finance it through the dealership. You're looking at about a $387 a month payment, right? When you've paid it back, because you're going to pay it back with interest when you finance it, you're actually going to pay that $20,000 plus $3,220 additional in interest. At the same time, if you have bad credit, you're going to finance that same car for $20,000 at a 10% interest rate. And that's going to make your payment higher, $425 a month. And over the course of the time you're paying it back, you're paying about $5,500 worth of interest in addition to the $20,000 that you paid back. Okay. So this just kind of shows you someone who has better credit is going to end up paying less over time because their interest rate is less. And that's very important to know, that your credit, whether you have good credit, bad credit, no credit, whatever, that affects what rate you get, as well as just cost comparison from, different banks and things before you make a purchase. But I'll talk more about that here in a second. Okay, so let's look at another example. So we'll say that this couple bought a house for $100,000, right? They put $1,000 down and they financed it for 30 years, which is about average when you're purchasing a mortgage or you're putting a mortgage on a house. So if someone had really good credit, they might pay 5% interest. So this is about where their payment's going to be, about $874 a month, right? If they have fair credit, which means it's not really bad, it's not really good, it's just kind of right there in the middle, it's going to be 8% interest. We'll look at how much it increases your monthly payment, and that's not even factoring in what you're paying over the course of time in interest, okay? And then let's go back to our bad credit example. So bad credit, 10% interest, has jumped almost $340 a month because this person doesn't have good credit. And this example goes on for a lot of other things, why this is important. And it's not just if you're financing things, because there are plenty of people that pay cash for everything. They are really good at delayed gratification. They save up the money to purchase their car, their house, their, whatever that they want to buy. And that's great. And I highly recommend doing that where you can. But there are other things that your credit can factor into. Did you know that a job, if you're hiring to get a job, they can look at your credit report and they can actually decide whether you get the job or not based on your credit history. Now, that's not to say that they're going to discriminate against you because, you missed a couple of payments. But what it tells them is whether you are a reliable person or not. Do you pay your bills on time? Do you have a bunch of bills and collections that you've not tried to even pay off? So it's going to tell them a lot. And you can miss out on jobs because of this, especially if you go into banking or finance or things like that. It's going to tell them that you're maybe not the most trustworthy person because your credit isn't good. Now, fair or not, that's just kind of reality. Also, insurance rates. What a lot of people don't realize is your insurance rates on your house, on your car, those things that you need to have insurance on can also be dictated by your credit score and by your credit history. And that's really important to realize. I mean, I've seen in my own rates at a time when maybe if my credit wasn't the greatest, where as soon as I paid off a credit card or did something that brought my score back up, all of a sudden that plummeted, like the cost just went way down. And it is very valid where two people, everything else being the same, could try to get the same insurance coverage. And if one has better credit, they're going to get a better rate. And for the same reason as jobs, it is going to tell that company if you pay your bills on time, if you are responsible, if you are what they call a good risk to extend that coverage to, or if you're going to be someone who is going to commit fraud or do something else unsavory with it. So it's very important that you're aware of your credit score and kind of where you are in your credit report. And once you get over the age of 18 and you are, using credit regularly, whether that be student loans or whatever, that you are monitoring your credit regularly. Okay, so the first credit score I'm going to talk about is the one you're probably going to see the most often. It's the one that is talked about the most often. It is the one that's pulled the most often when you apply for things. And it's what's called your FICO score. And FICO stands for the Fair Isaac Corporation, which is the company that actually invented the credit score. For a long time, they were sort of the be all to end all of credit scores, and they still kind of are. You don't see the second type I'm going to talk about very, very often. All right, so as I mentioned, a credit score, and both of them have the same scale. So credit scores can be anywhere between 300, which is bad or no credit, up into 850, which is excellent credit. This means that, you pay all of your bills on time and you keep your credit utilization low, which I'll talk about here in a second, and you do kind of all the things that you're supposed to do. And as I mentioned, the higher your score, closer to excellent credit, the better your interest rates are going to be when you do try to finance things. Even if you put a down payment on a car, it's still going to factor in if you have to have a car payment. And so it's really important to kind of know where you stand and to monitor this, especially before you finance something. All right, so let's talk about what makes up a FICO score, because both the FICO and the Vantage are a little bit different in what they include as what they look for when it comes to your score. So with the FICO score, your payment history is the largest percentage. And it is arguably one of the most important things that you can do for your credit. And that makes up, do you pay your bills on time? Do you pay the entire amount due when it's due? Or are you short on what you're paying? It's extremely important. And I'll talk about that in a little bit more detail here in a little bit. And then the next is what we call your amount owed or your credit utilization. So your credit utilization is basically a fancy word for, are you maxing out your credit cards? I'll give you kind of an example. So your credit utilization, if you have $1,000 credit card, and I should have mentioned this at the beginning, if you want to answer my questions, put it in the chat. Normally, I would have you guys just unmute yourself and talk to me, but there's quite a few of us on the calls. So I want to make sure that everybody can hear me. So we're going to have you just put it in the chat. So that being said, if you have $1,000 credit card and you have spent it up and put all $1,000 on it, you've spent the entire $1,000 that they've given you, what is your guess of what your credit utilization percentage would be? I don't have anybody brave on here. I see. There we go. 100%. Yes, your credit utilization would be 100%. Oh, we got some connection issues. Okay, I will repeat what I said. What I said is credit utilization is the percentage of credit that you're using versus how much credit you have available. So in the example I gave, if you have $1,000 credit card and you spent the entire $1,000, what is your credit utilization? It's 100%. Very good for those of you who popped that in the chat. And I'll talk about this in a little more detail here in a minute, but sort of the magic score that we tell everybody is to keep that credit utilization down below 30%. So in this case, you would only be looking at keeping less than $300 on that credit card and trying not to spend more than that $300 on the credit card to keep yourself at 30% credit utilization. Ideally, you use your credit card and then pay it off every month. But sometimes that's not an option. So trying to keep it down below $300 on that $1,000 credit card or below 30% overall helps that credit utilization number. Because, you know, a bank is going to see you as a risk. If you have utilized all of the credit that's offered to you all of the time, they're not going to want to give you any more because they think you're just shopping for money. So the next is the length of your credit history. That is 15% of your overall score. This goes on the longer you have accounts. So if you guys go into college, you do end up having to take out a student loan. That student loan is going to be an account on your credit report. And eventually, as you get older, as you've been utilizing credit more, you've been paying more, your accounts are going to average out. And that average is what's called the length of your credit history. The next is going to be new credit and inquiries. It does not look good when people inquire about your credit. And I will explain what I mean by that. When you go to apply for something, if you go and activate a new cell phone plan with a contract. So, you know, say you go to AT&T or Verizon and they give you a brand new phone and you sign a contract saying that you're going to, you know, pay such and such amount for that phone. What they're going to do is they're going to pull your credit report or they're going to check your credit before they issue you that phone with the payment. And every time that that happens, it's what's called a hard hit on your credit. And that means that you have applied for credit somewhere. You have asked a bank to give you money, whether you are approved or not. You pulling your own credit, which I'll talk about here in a minute, is what's called a soft hit. So when we're talking about new credit and inquiries, this takes into account how many times you are applying for credit. So if you are applying at every store at the mall that you shop at regularly for a charge card, every single time you apply, it is going to be a hard hit on your credit. And the point is to have less, as few as possible. So only applying for credit when you absolutely need it. Because the more you have, the worse it looks. Because as I mentioned, it looks to a bank that is going to look at your credit report. It looks like you are just fishing around for money from whoever will give it to you. And it makes them less likely to approve you. So, and that also factors into 10% of your overall credit score. It can make your credit score go down if you have too many. And then the next is what they call credit mix. So this is just a number they look at of what types of accounts do you have? Do you have nothing but credit cards? Do you have a student loan and a credit card and maybe a car loan or a mortgage? They look at kind of the mix of what types of credit you have, and that factors into 10% of that overall score. And I'll talk about this very briefly. In 2020, FICO changed a few of the things that they look at. They still look at all of the things I just mentioned. But they grade what's called delinquency, which is when you have not paid your bill by the due date, it becomes delinquent on day one after you have not paid it. They judge you being delinquent on paying your bills and your overall credit utilization a lot harsher. It doesn't affect your overall percentage, but what it's going to do is when a bank looks at it, it's going to be like, well, they you know, keep their credit utilization consistently high, or they are consistently late on their bills. And that's going to look worse for you because they're actually going to look at what they call 2-year trend data, which is basically over the 2 years prior to you applying for whatever you're applying for, it's going to look and see how much you've used credit and how you've paid your bills and if you've paid them on time or if you've been delinquent on them. All right. And then let me talk about Vantage scores. This is very similar, so I'm not going to get super into this slide, but it is the same scale. But what they factor and how they factor it in is a little bit different. And the reason I share Vantage scores is because it has become a lot more prevalent in the last 5 to 10 years, where some places that you apply for credit will use a Vantage score versus your FICO score. So it's important, even though most of the time you're still going to deal with a FICO score, to at least kind of know what a Vantage score is. So with a Vantage score, your payment history is actually weighted higher. So it is 40% of your overall score. The depth of your credit, which is their kind of fancy term for your credit mix, that is 21% of a Vantage score. Your credit utilization, which we talked about before, is 20%. So how much of your available credit are you using? What are your balances? Do you keep a balance on your card? You know, there's an old money myth that I know I heard growing up. I'm sure there's a lot of people that heard it growing up, which is you have to carry a balance on your credit card in order to have good credit. And that is the most giant lie that I was ever told, because you don't. It actually looks better if you can pay your credit card off every month and that you don't spend more than you absolutely can afford to pay for. Because they do take into account your balances that you carry on your cards, and it looks negative if you're carrying a high balance. Also, that 5% you see on the screen is going to be recent inquiries. Are you going and applying at every store at the mall for credit? And then your available credit. So how much of that credit utilization, how much do you actually have available? You know, it's okay if you have $1,000 credit card and you've got 30% credit utilization, but do you only have that $1,000 worth of credit? Do you have a couple of credit cards that have that amount? And so it does take into account if you have credit from more than one place and how much credit is extended to you. Now, that is not me telling you to run out and get a bunch of credit cards. That is me simply explaining that that's what they look at, because honestly, I would say stay away from them unless you absolutely need them. But let's kind of talk a little bit more about this. So your payment history in both scenarios factors in your credit cards, your retail accounts, student loans, car payments, mortgages, any of those type of loans that you might take out utilizing a credit card. It also takes into account things that are public record. So if you have, say, a medical bill that comes in and you don't pay it, and it goes to collections, that is considered a public record. So that will end up on your credit report. Things like foreclosures. If you don't pay your mortgage and you get your house foreclosed upon and taken away from you, that ends up on your credit. If you don't pay your car payment and they repossess your vehicle, that is, will appear in your payment history and it will look negative on your payment history. Same thing of defaulting on student loans or any kind of wage garnishment, which if you're not sure what that means that whoever it is, whether it's child support or student loans that you haven't paid, or I don't know, someone has brought a judgment against you in court that you owe them money. They're able to go to your employer and show legal papers saying that you owe them money, and they're able to take that money out of your paycheck. If you get yourself in that type of situation, that can cause you some major trouble. And that also ends up on your public record in your payment history. So all of those factors go into that big score, because whether you're talking a FICO score or Vantage score, that largest percentage is your payment history. So this is, do you pay your bills on time every time? And do you take care of your responsibilities? when it comes to paying your bills. That's what all of these factor into to tell a bank. Okay. So if nothing else that sticks in your head from this presentation, if you are going to utilize credit, it is vital to make sure that you are utilizing the credit and you are paying at least the minimum balance every time, every single month. And if for some reason you can't, that you are talking to your creditors. I'll talk more about that here in a minute. And then, as I mentioned earlier, I'm not going to get too much more into this, but what we call the magic credit utilization number. So if you're going to utilize credit, make sure you are holding steady at less than 30% of your overall credit. Because if you start maxing out your credit cards and maxing out what money you can take out and you're not using it responsibly, it will really, really make a big negative impact on your credit. Okay, before I move on, you guys are welcome to, in the chat, pop in any questions that you have right now.
Colin, they've given us the opportunity to record this, and so Jennifer's doing that, and it will be made available later. So if you're having technical difficulties or you came in late, they've been gracious enough to let us use this material so you can watch it later. So thanks for joining us.
Awesome. Okay. I don't think anybody else has any questions. So if you think of something, you have a question that's just burning in your head, put it in the chat. Even if I don't answer it right away, when I get to this slide again, because I've got it put in this presentation a couple of times, I will go back and I will answer whatever questions you guys have. So put that in the chat if you have one. So let's talk a little bit more in depth about what causes a bad credit score and things you kind of want to avoid. So things like unpaid utility bills that go to collections, unpaid medical bills, unpaid cell phone bills, unpaid credit cards. Those are pretty obvious. Some of them may be less obvious things that can damage your credit. Broken rental agreements. If you sign a lease at a place and you have to break your lease and you don't pay them the money that you've agreed to pay them in the lease, if you have to break it, that can damage your credit. Defaulted student and personal loans. Defaulted student loans can damage your credit for a long time. You know, part of my job, I work with Ready, Set, Repay, which is all about student loan management. And I talk to students trying to get back in school. I talk to people, you know, who are maybe down on their luck, who have defaulted on their student loans and want to go back to school and can't. And this is major. They stay on your credit for a long time, like until you bring it back out of default, which is when you haven't paid it for 270 days or more. It can cause a lot of problems. They can pull your tax returns. They can pull money out of your wages. They can pull all of that stuff to repay your student loan balance. So it is very important, if you do take out student loans, that you are paying them on time. Vehicle repossession. I mentioned that earlier. If they have to take your car back, if you are overusing your available credit, using the wrong types of credit. I don't know if you guys have seen them, but sometimes you'll see that like cash advance places. They do like payday loans. Those are bad news, you guys. Like, I can tell you a personal story with this. So when I was growing up, I was raised by a single mom. Okay. There was a couple of times where money just got real tight, and my mom went and got those student loans, those payday loans. And they are real sneaky, and they don't tell you that those loans have huge interest rates. You know, I was reading about it the other day, and in Oklahoma, their interest rates can be 300 to 600% on top of whatever it is you borrowed. So if you borrowed a couple $100, you might be paying upwards of, you know, an additional 100 or more on top of that. And they're expecting your payment due. So it starts to roll over and it snowballs. And in the case of my mom, they snowballed so much that she ended up having to file bankruptcy when I was a junior in high school. And we lost our house, we lost our cars, we lost all kinds of things. So it's a really bad idea. You know, I'll talk to you a little bit about how you can avoid having to use those. Just don't. So also co-signing for someone. I always say this, and especially, you know, around your age, a lot of times you're like, I don't even know what that is. Why would I co-sign for someone? But I like to get in here and get in your heads before you get on and get to where you have access to credit, because co-signing for someone can really, really damage your credit if you don't completely trust them. If you're not familiar with what co-signing means that you are basically allowing someone to use your good credit score to get themselves money. And they are responsible for the payments initially, but if they don't pay, the bank is going to come after you for the money that they owe. And that is a problem for two reasons. One, if you don't have the money to pay it, then it damages your credit. But also, if you're trying to finance a house or do something else, it can make your debt look higher than it actually is because it goes on your credit too. So unless you 100% trust a person and you know for a fact that they are going to pay back that loan, don't ever co-sign for someone because it can very much damage your credit. And also identity theft. It is very important to monitor your credit regularly because identity theft happens. You know, identity theft is when someone gets access to your personal information, your birthday, your name, your social security number, any number of things. And they use it to pretend to be you and activate accounts, and they can take money out, drain your account, and it can cause lots of damage. It can cost months of your time trying to fix your credit after that's happened. So now let's talk about how you build good credit. So you guys are, you know, all starting from ground zero, and that's a good place to start. So the best thing is to make sure that anything you have, you're paying it on time every time, regardless of what it is. You're paying at least the minimum balance, but you're also paying it off in full if you can. My advice when it comes to credit cards is if you have them, make sure you are only putting on them what you can pay back that next month. Pull it out of your budget so you can pay for it, because that is a really slippery slope if you start using it for things that you don't have the money for. Limit new cards and debt, meaning only take out what you need when you need it. So don't go apply for a bunch of credit cards. Don't go apply for a bunch of loans if you don't need it. And before you apply, make sure you're doing your research. So going in and going someplace like creditcards.com, you can go in there and you can actually compare credit cards before you apply for them. And you can see what their interest rates are. You can see what fees they have associated with the card. You can see what benefits they have. If they have any kind of annual fee, which you're going to want to try to avoid, because then they're going to charge you just for having the card, even if you don't use it. And you can look at all those things before you apply. So it prevents you from having a bunch of credit inquiries because you're trying to see what interest rate you can get. Make sure you're paying off your debt. So don't get into debt if you can't afford it. You know, sometimes it's worth the delayed gratification of saving up for something. Making sure you have an emergency fund falls into this category too. I have a lot of students when I go and I talk about budgeting, I'm like, what do you think? Is it a need to have an emergency fund? And a lot of people say it's a want, that they want to have an emergency fund. And I can emphatically tell you that is not the case. The key to being smart with your credit, to keeping yourself out of debt trouble, to budgeting successfully in your adult life is having an emergency fund. Having at least $1,000, generally rule of thumb is 3 to 6 months worth of your income in savings. The reason being because things happen. Personal examples in my own life, in the last 5 years, I have gotten into a major car accident that I had deductibles and things that insurance did not cover. That had to come out of my emergency fund. I have had a dog get really sick and I did not have the money to pay for the treatments to take care of him. That had to come out of my emergency fund. I have had a freak hailstorm went through my house in Norman a few months ago, if you guys were watching the news, and it dinged up my car pretty bad, and I had to pay the deductible for my insurance to get it fixed. Those are all things that came out of my emergency fund. Now, if I had put that on credit versus having an emergency fund for those things, I would still be paying it off months later. But because I have an emergency fund, I was able to pay that cash, get it out of my hair, not worry about it hanging over my head. And then I just took a little bit of money every month and started slowly building back up that money. And it doesn't have to be a ton. I mean, I know I threw out $1,000 in 3 to 6 months. That's a lot. I know, for especially, you know, when you guys are just kind of starting out, you're working, you know, your high school jobs and all of that. But even if it's $5 to $10 a paycheck, every cent that you have in savings is 1 cent more that you don't have to put on a credit card, and you can use the credit cards for what you actually need them for, or use the student loans for what you actually need them for. And so you don't get yourself into credit trouble in the long run. Also, making sure that you monitor your credit regularly. I'll talk here a little bit about how to use annualcreditreport.com. Once you get old enough to go in and check your credit on a regular basis, you should go in at least once a year and check your credit. Annualcreditreport.com allows you to check your credit for free once every 12 months from all 3 credit bureaus. And it's really important that you go and you do that and you look through your information to make sure there are no collections you weren't aware of that you need to take care of. There aren't any discrepancies, you know, misspelled names or miskeyed socials or, you know, anything like that that's damaging your credit. You know, I one time went in and checked my credit, and there was a collection for a medical bill that I had paid like years ahead of time. And they tried to take me to collections for it. And I was able to dispute it, and they removed it because it had already been taken care of. If I hadn't been watching that though, it would have caused a major issue. If I had tried to go and finance a car or something like that, they would have seen that collection and it would have damaged my credit and made it to where I couldn't have gotten the vehicle. Also borrowing smart. And this is really important as you get into college, when you start going towards possibly, you know, student loans. First, using the free money, so grants and scholarships, as much as humanly possible. If you have family members or you yourself have saved up money to pay for school, using that first before you start taking out student loans. And when and if you have to take out student loans, making sure you are taking out the bare minimum that you need and not taking out any more than you absolutely need, because they definitely can snowball and cause you lots of debt headache. So making sure that you're being smart about that. And then talking to your creditors. So if something happens, talk to your creditors, call them. They don't run away from it. Don't, you know, be an ostrich and bury your head under the pillow and act like it doesn't happen, because what's going to happen is they're going to come after you for the money that you owe them. And they're a lot nicer if you contact them first. I'll give you a perfect example. I got laid off from a job a few years ago. It happens in adult life. You know, sometimes budgets get cut and they just cut your position and you have to deal with it. That's the other reason that having an emergency fund is really important, because that is just a fact. But the very first phone call I made out to my car, as I'm walking out to my car with my stuff, was to my student loan servicer. And I called and I said, hey, here's the problem. I just lost my job. I'm not sure exactly when I'm going to get paid again. And I don't know what to do because I don't want to default on my loans. And they were really fantastic about it. They said, you know what, we can help you. We can, you know, I'm going to send you some paperwork so you can apply for a deferment. And it'll make it to where you don't have to make your payments for a certain number of months. I think they gave me like 6 months to get a job. And they're like, you don't have to pay it for 6 months. And, you know, it'll keep you in good standing. We know what's going on. And even a credit card company, sometimes they're not quite as forgiving as like a student loan company. But even then, in that same scenario, I called them and I said, look, I just got laid off. I'm not going to be able to make my payment. And you know what they did? They waived the late fee. And they said, well, look, you know, we can't pause your payment. That's not something that we do, but we're going to waive the late fee because you called and you told us about it. So you're not gaining more of a balance to pay off. And it's not, we won't mark you, against you for it because you called and told us ahead of time. So I still ended up having to figure out how to make the payment, but it did help. They did help me out as much as they could within their abilities. So it's really, really important that you reach out, talk to them first when you've utilized it. Okay, so, and then here's just some tips to stay out of credit trouble. We're gonna call this things that Sarah wishes that people would have told her when she was your age. And we're gonna, these are my little nuggets of wisdom that I hope that you'll take with you. First, having debt is promising your future income for something that you've already purchased or used, right? So when you are utilizing a credit card, you are utilizing a student loan, you are financing a car, realize that you are promising your future income for however long that is to whoever that creditor is. So that money, until you have paid off that debt, is no longer yours. So you are, if you get too far into debt, you are literally working just to pay off your debt. And that is not a good place to be. So make sure that you understand that and you think very hard before you take out credit. Now, I'm not telling you never to use it because there's a lot of big purchases that you may not be able to make, like a house, without utilizing credit, but think carefully before you do it. Never use your credit for something you can eat, wear, or listen to. Don't do it. You will send your credit card balances to the sky before you even realize it. Utilize credit cards for things that you have to purchase. Don't just use it, to use it. It's not free money. You have to pay it back. And if you don't have the money to go out to eat or to wear something or, to download something, you don't need it. If you can't get it from your regular paycheck, you don't need it. If you get a credit card or a loan, make sure you are comparing their details before you apply. I mentioned this earlier, creditcards.com is a great place to go if you are going to get a credit card to compare cards. Now, I just recently got a travel card because I have all my family is on the East Coast. And so we travel there a lot. And my boyfriend and I talked about it. And I was like, yeah, I think I'm going to get a travel credit card because we're traveling so much that actually would benefit us so we can get the points. So what I did was go to creditcards.com and I compared all of the travel credit cards, which had the best interest rate, which, had the best APR or what's called your annual percentage rate of interest that you're going to have to pay, which had an annual fee and which didn't. So that way, when I applied, I had one inquiry because I had decided on one card that I was going to apply for instead of applying for all of them. And then don't spend more than you have. And if you have to spend more than you have, say you do have to finance tires for your car or something of that nature, have a plan to pay it off before you purchase it. Now, whether that is trimming down your budget, maybe canceling some subscriptions or something and taking all of that money and throwing it towards paying off that debt till it's paid off, make sure you have a plan before you purchase it. Don't just get purchase happy and then try to figure it out later because all of a sudden you're going to look up one day and be like, what in the world did I do? All right. And then to avoid debt, I've mentioned this a little bit, but stick to a spending plan. I hate the word budget, so we're going to call it a spending plan because it's much easier for me to wrap my head around how I'm going to spend my money versus budgeting my money. So stick to a spending plan. Have a plan for where every dollar is going. And by doing that, you can utilize things like sinking funds. You'll see I got up here on the screen. A sinking fund is like a savings account, if you will, but it could be something as simple as like an envelope where you keep cash separate for whatever it is you want to save up for it. So have a sinking fund for Christmas presents, have a sinking fund for, the new Xbox that you want or the new PlayStation that just came out that you want. save up for it. You know, don't utilize credit to purchase it. You can create yourself a separate little fund. You know, I'm actually getting ready to go on a vacation. I'm from New York originally, and we're going back home so I can visit. And my boyfriend and I have an envelope that, you know, we are throwing every spare like $5 bill that we have in there so we can have spending money on the trip. It can be something as simple as that. Save up, delay gratification so you don't have to use credit if it's not absolutely necessary. Also, I mentioned this before, I'm going to say it again, have a healthy emergency fund. Things are going to happen. They happen to the best of us. That is literally just life. You know, I have, my stepdaughter is 18. She just graduated. She actually today is moving into her first apartment. And that was the first thing that we went over when we sat down and talked about her finances when she was getting ready to move out is, what are you going to do if there's an emergency? How much money every paycheck are you putting back into savings in case you need it? Because, you know, she doesn't want to utilize credit, and that is where she doesn't have to. And that is the best strategy. Because remember what I said, having debt is promising your future income to pay for something that you have already used or purchased. All right. And then I'm going to very briefly go over this, and then we can, I'll answer, I see some questions in the chat. I'll answer those here in just a second. So I mentioned this annualcreditreport.com. So annualcreditreport.com, as I mentioned, allows you to check your credit once every 12 months from all three bureaus for free. And Xander, I see you mentioned in the chat that you've heard checking your credit score can lower your score. When you pull your own credit, it's what's called a soft inquiry. So when we were talking earlier, we talked about the difference between hard inquiries or hard hits and soft hits or soft inquiries on your credit. And a soft inquiry is when you check your own credit. A hard hit is when you actually apply for credit. So the things that go against your credit score are the hard hits or the credit inquiries. You pulling your own credit does not damage your credit score as long as you do it, you know, once a year. I utilize Credit Karma. I still check it once a year, all three reports, because you can go through and look at details. Like, you know, there's people behind the scenes at those three bureaus, and they make mistakes. So, you know, they might key in your social security number wrong, or they might key in your name wrong or something like that. So you want to make sure you check it to make sure that information is correct. But I utilize like Credit Karma just because they tell me if some weird account pops up on my credit report. And it gives me kind of that real-time knowledge if something is going wrong. But it's still smart to go in once a year and check it. And that doesn't hurt my credit at all to go in and do it because it's a soft inquiry. So anyway, that being said, annualcreditreport.com, you hit this big red button down here at the bottom that says request your free credit report. It's going to have you fill out a bunch of information. You know, your name, your last name, your social security number, addresses that you live at now and before. Now, if you are under the age of 18, you're probably not going to be able to do this because you don't have any credit right now, more than likely. It is very, very unlikely that you will have any credit in your name right now. But whenever you do check this, make sure you are at annualcreditreport.com and that it is not asking you for any kind of credit card information, because sometimes if you Google this site, other sites will come up that will ask for your credit card information, things like that. The actual annualcreditreport.com does not ask for that. So make sure that you are on the right site. Anyway, so it asks for all of this information. And then what it's going to do is it's going to give you another page that's going to have a bunch of information about accounts that are on your credit. And it's going to ask you some questions like, I see in 2010, you purchased a house at XYZ address. And what was the bank you used to finance that first loan? And it might be 3 banks and then none of the above. It's very possible it's none of the above. I've gotten plenty of none of the above questions. So it is kind of important that you sort of keep an eye on things that you have going on. But that's just an extra layer of security to make sure it's you, that you are the only one pulling your credit. And then it's going to bring you to this screen, and it's going to allow you to select all three or just one. I have a coworker who actually does, she'll check Experian in January, she checks Equifax in March, and she sort of spreads it out. So that way, instead of using something like Credit Karma, she's checking it every couple of months to make sure that there's nothing weird going on her credit report. All right, and this is kind of what it's going to look like. It's going to have your personal information, your job, your address. It's going to have how long you've had credit. It's going to have what accounts you have. You have any collections or public records against you, it's going to tell you that. And then it's going to give you a detailed breakdown of every single account, everything, your payment history on that account, who the creditor is, when you opened it, what the high balance is, all kinds of information. And it's your job to keep an eye on it because things happen. I'll give you a good example. So my boyfriend there is a gentleman also in Oklahoma City whose name is spelled the exact same as his, except for their middle names are different. And there's legitimately been times where he has had to check his credit and then dispute something because they have keyed in the wrong middle initial. And it has ended up being this other person's information. So it's very important to make sure it's all your information and it's all correct. All right, so I am going to get back to your questions in the chat, but here are some resources that are really, really good. There is our website, oklahomamoneymatters.org. That gives you a ton of stuff on budgeting and credit and paying for college and all kinds of stuff. So please go and check it out. They've got some really good learning modules if you want some more information. Also, these next, greenpath.com, or what used to be called Consumer Credit Counseling of Central Oklahoma. They help people who are in debt. So I always like to give that resource out in case you know anybody who is in debt and is trying to get out. NFCC.org is like the big national nonprofit organization that helps with that. So if you are outside of the scope of the Consumer Credit Counseling of Central Oklahoma, you can go to nfcc.org and actually find a nonprofit that helps people in debt in your area. Some other really good blogs and things about money that I recommend and that I follow myself. Dave Ramsey, if you've never heard of him, he has some pretty solid advice. He is completely anti-credit, which I am not, but he's really, really solid advice as far as paying off debt and getting yourself out of debt. And then also the Budget Mom. I know you guys are probably not parents yet, but she has really solid advice as far as how to budget, how to set up sinking funds, how to manage without using credit unless you have to. Also, the Budgetnista. If you've never seen her, she is awesome and has some really good advice. So that is her blog site. Lots of good information. And then nerdwallet.com, I go to a lot if I have questions about finance stuff. So I think that you will find it really, really interesting. All right, I'm going to go ahead and go back into the chat because I saw some other questions real quick. Okay, so if you find a balance of, so you have to find a balance of source. You personally, okay, I don't think I am understanding your question. Okay.
Xander, I think you can use your microphone if you want, but maybe he means like he'd like to check his credit more often, but he doesn't want to get penalized for it. So is he saying you just want to find balance?
Personally, I'm one for like always making sure it's all good, don't want to mess it up. And then I don't want it to be where it's like I check it maybe once every month and then it's like -10 or something every time I check it because, oh, well, you're too concerned about it, buddy. You better,
Well, that's a really good, it's a valid concern. But like I said, when you pull your own, it is what's called a soft inquiry. So it does not negatively affect that inquiries on your that inquiry number that we talked about. But you could always use something like Credit Karma to monitor it monthly. That's what I do personally. I have the Credit Karma app where it monitors Equifax and TransUnion, Experian and TransUnion. 2 of the 3. It monitors them every single month. And that, it's not a perfect science, but it at least lets me know if something weird happens. Like I don't have to go in and check it every month, but if like a weird account pops up, they will alert me and let me know. So I don't have to check it, but like I can go in and check it, and that doesn't do anything to my credit. With the once a year, that is actually going to annualcreditreport.com and pulling the whole thing, because you can actually see most of what's on your credit report on some up thing like Credit Karma. But the good thing about the annualcreditreport.com is if there's anything you have to dispute, it gives you the information of how to dispute it with each individual company, and because it's specific to that company. Whereas Credit Karma, if you try to do it through there, sometimes it works and sometimes it doesn't, because it has to go through like a third party. So I use it just sort of peace of mind kind of thing, but then making sure you pull the whole thing and look at it very carefully once a year. And I think that that would be okay. All right, let's see. We've only got a couple minutes left, so I'm going to try to get to some of these questions, but up here on my screen is my email address. So if I don't get to your questions, please feel free to send me an email. If I can't answer your question, I will find someone who can. Let's see. Gabriel, you said, so when you do get credit, do you start with a certain amount or do you just build up? It's going to depend on what you're applying for. And generally it depends on the bank or whoever it is that's giving you the money. If say you're getting a credit card, they may give you a smaller balance first. Like way back, I think I was maybe like a sophomore in college, junior, something like that. When I got my first credit card, the balance they gave me was like, I had $300 and that was the limit. That was the max I was allowed to spend. And I went in and I put gas on it, which I was going to end up paying for anyway. So I just paid off the gas. You know, I figured out how much I spent in gas every month. I used that to fill up my car. And then when it came time for the bill to be due, I would pay it off. And that was how I started building my credit. And I just didn't allow myself to do more than that. So I think that would probably be smarter. They're not going to just give you a certain amount. They're not going to just be like, oh, here's $4,000 to spend however you want. They're going to make you prove that you're credit worthy. So they're more likely to start you with a smaller balance. And once you've proven that you can be responsible with it, they'll give you more. Okay. And I think that's all the questions I have in the chat. Does anybody else have any other questions or concerns or anything else? Okay. Oh, good. We do have some questions. Okay. What happens if you have bills to pay, but you're put under witness protection? That's an interesting question that I have never gotten before. I honestly don't know. I would have to look up. I would assume that they would probably go away because your identity would change and they would be with the old identity, but I honestly don't know. That's just a guess. Okay, and then Gabriel, what kind of credit score do you start with? You don't start with any credit score. And if there is one, it's probably going to be closer to that 300, lower credit range because you don't have any credit. You don't have a credit score when you very first start out. So you have to earn what you get. So you can either mess it up really badly, really fast, or you can build it up well, really fast, depending on the decisions that you make. All right, we are right at 3. Does anybody else have any information before I hop off?
Thank you for joining us, Sarah.
Thank you guys so much for having me. I'm glad we got to sit and chat. I hope everybody got a lot out of it. And I hope you guys screenshotted my email. So if you do have any questions, feel free to send them my way. And I appreciate y'all being so interactive and talking to me today. It's been really fun.
Yes, we appreciate it. And thanks for sharing those stories. One thing I'd encourage you all, like she said, she shared some information there where you can contact her as we meet with people. Like tomorrow we meet with Murray State for a tour of their college. Get the information, because you won't remember every single detail of what they say, but if you have that name and contact, you'll be able to follow up when you have questions about a certain college or how to save money or what to do with credit reports, those type things. You'll have somebody to contact. So make sure you take advantage of those. Thanks again, Sarah, for joining us. I'm glad to see around 50 students, 45 to 50 students on with us today. So that's great too. I appreciate you all taking your time to be with us today. Tomorrow's meeting will be